And if you're thinking like, Kate, geez, some other YouTuber was all about refinancing. Yeah, are they getting paid by the refinancing companies? Because I'm not. Hey, Smarty fans. If you've been looking for ways to reduce your student loan monthly payment, pay less in interest, or just make your dozen or so student loans more manageable, you've probably come across the terms consolidation and refinancing. And if you're a new graduate with new student loans, you should probably really be considering consolidation. Although consolidate and refinance sound very similar, like they mean the same things, they do not. Kind of like the terms cottage in a forest versus cabin in the woods. The words are synonyms, but one sounds like it is filled with flowers and sprinkles and cupcakes, and the other one sounds like the opening scene of about 40% of all horror movies. If you choose badly, you could be paying hundreds more per month and potentially thousands more over the course of your student loan. And what's worse? You could lose out on all that student loan forgiveness going on, making this a really confusing and stressful decision, like a big decision. That's why I'm making this video, so you can feel really secure doing one or the other, or maybe deciding that neither is right for you. You'll learn what student loan consolidation and refinancing is, how they work, and which might be a good idea for you, or which might be a terrible idea for you, and why. So be sure to watch to the end, because I want to make sure that you really understand both of these things, and so that you never confuse one for the other. That'd be like going on a weekend trip thinking you were going to a cottage in the forest when you find out you're going to a cabin in the woods. I'm Kate, the money librarian, here to help smart people stop feeling dumb about money. Let YouTube know that this video is actually helpful, and so that more people see it, bop that little thumbs up. Thanks. Okay, this is not comprehensive. My God, that would be a long and boring video. This is informational and educational only. You gotta consult with a financial pro to really find out what is best for you. You are not dumb for being confused about consolidation and refinancing. This stuff is genuinely confusing, and it doesn't have to be. You got this. Here's what those two terms actually mean. Consolidation is taking all or some of your federal student loans and turning them all into just one loan. The way it works is the Department of Education technically pays off your student loans and makes those into one new loan using the former loan's balances and interest rates. You still owe the Department of Education that money. It's just way easier to keep track of one loan rather than well over a dozen or so. And here is like the big main difference between consolidation and refinancing. Consolidation keeps your student loans with the Department of Education. Because this new loan is still with the Department of Education, you get to keep all the big benefits of having federal student loans. The biggest benefits of federal student loans, yes, include, forgiveness, but they also include a lot of stuff like income-driven repayment plans, or allowing you to simply not pay if you go through times of particular hardship or if you go back to school. Let's talk about refinancing. Refinancing is when you take some or all of your federal student loans, maybe even some private student loans as well, and move them to a commercial bank. The way refinancing works is a commercial bank pays off your federal student loans, and sometimes if you have other private debts, you can include this with the new student loan, and now you owe that commercial bank all the money at a different interest rate than what they were. Sometimes these are fixed interest, sometimes they're variable interest. Fixed meaning the interest rate will never change over the life of the loan. Variable meaning it could change at any time, for funsies. When you refinance, you lose out on all the federal student loan benefits, but most people decide to refinance because they can just get a way better interest rate if they move their federal student loans to a commercial bank. Like if you're paying 7% on $100,000 and you could pay 5.2%, like that saves you a lot of money. So it makes sense for a lot of people. But just like a mortgage or a car loan, you're going to owe them that money every single month, no matter what. Now, that said, every company works differently. Some commercial banks do offer unique benefits to refinance student loans. Every company is different, and they will be more than happy to tell you about how great their loans are if you ask. Now that you understand the basic differences between the two and how they work, let's talk about what actually happens. What you lose, What you gain, yay, when you consolidate versus when you refinance. If you want to stress less, save more, and get control over your cash, check out my 24 easy money moves, link in the description. The big benefit of consolidation is just it is way easier to handle your loans when you don't have 15 different loans to look at, you just have one. That is the big benefit of consolidation. And like I had mentioned before, by keeping them with the federal government, you leave yourself with a lot of options. You go back to school, you lose your job, you need to stop paying for a while, no problem. Want to lower your monthly payment? No problem. There are a ton of different payment options. You've been paying for 20 years and now you're eligible for forgiveness? Awesome. You're done with your student loans. Paid off. Those are just the major benefits of having student loans with the federal government. Other good stuff you get when you consolidate is you might have loans with different servicers, which just gets confusing. When you consolidate, you can just put all of them into one servicer, so you only have one place to check. Consolidating non-direct loans into a direct consolidation loan may open up other payment options for you. Mostly, you'll have access to all 4 income-driven repayment plans, all of which offer some type of forgiveness. For example, neither FFEL or Perkins loans can be paid under the new Save Student Loan Repayment Plan, which could lower your monthly payment to as low as $0 per month and keep interest from accruing. But if you consolidate them, you could get on Save. Consolidating can also open up public service loan forgiveness if your loans currently don't qualify for PSLF because you have the wrong kind of loans. And the last big benefit is you get a fixed interest rate, which is just very nice instead of having a variable interest rate, which goes up and down and who knows. But it ain't all roses, and you might be giving up some really important things by consolidating. So let's talk about what you're giving up when you consolidate. One of the huge drawbacks of consolidation and big reasons why people don't consolidate is because you lose your payment history. Remember, we're taking all those old loans and making a new loan out of them. And this is also why consolidation is really a good idea for people with new loans, because you don't have any payment history to lose. If you have 8 years of PSLF qualifying payments and you consolidate, you could lose those 8 years of PSLF qualifying payments. Not worth it. Not worth it. Maybe you've had FFEL loans since 2005 and you think, ooh, I could consolidate and then I'll get forgiveness in 2025. Nope, because you lost that history. Your forgiveness clock starts at the time of the new consolidation date. Ooh, I think I ate some chia seeds before this. I have to check if I've got chia seeds in my teeth. Another drawback is any outstanding interest on the loans you consolidate becomes a part of the principal balance of the new loan, meaning interest may accrue on a higher principal balance than if you had consolidated. And right now, the government is talking about forgiving $20,000 worth of interest for people. So like if that does go through and they start forgiving up to $20,000 worth of interest, you probably won't get that because the new loan won't show all the money that is actually from interest from the original loans. It is also possible to lose benefits that you were depending on. Like if you wanted to get Perkins loan cancellation and then you consolidated your Perkins loans into a direct consolidation loan, you don't have Perkins loans anymore, so you can't get Perkins loans cancellation. And Perkins loans cancellation gets rid of your loans in 5 years. I have a video coming out soon about all the biggest loan forgiveness and cancellation programs, so be sure to subscribe if you want to learn more about that from me. And I would be remiss if I didn't talk about Parent Plus loans. I mean, Parent Plus loans stink in so many meanings. You could have 15 of your own federal student loans totaling $100,000 and one Parent Plus loan worth $500. And if you consolidated that one Parent Plus loan with that $100,000 of your own student loans, now the entire loan has to follow the Parent Plus rules, which are much, much, much tighter and more restrictive than regular direct consolidation loans. Now you can't get on any income-based repayment plan other than ICR, which really is a terrible repayment plan. Even if it says direct consolidation loan, it will have that stink of a Parent Plus loan on it. Watch my video on the double consolidation loophole that closes in July of 2025. It is so important, so do that after this. Maybe you're thinking to yourself, no, I don't need any of those federal benefits. I just want a lower interest rate. Refinancing might be the way for me to go. Refinancing is also good for the right person, let's get into the weeds of refinancing. With refinancing, unlike consolidation, you can actually include private student loans with your refinanced loan of the federal student loans. And you can't do that with consolidation. Consolidation can only be done with federal student loans. The interest rate is going to be determined by the bank you go with and your credit score, not the current interest rate that your loans are at. Be sure to watch my video on how to bump up your credit score. You're going to get a better interest rate. If you're thinking about refinancing, I certainly recommend that you shop around, check online places, go to your local bank, go to your local credit union who you normally shop or normally bank with. What you're mostly looking for is a great interest rate, and then also to see what other benefits they have for student loan consolidation loans. Like I said, some offer more flexibility for a student loan consolidation loan than they would for a car loan or a mortgage or something like that. Let's talk about the benefits of refinancing. Okay, there's really only two. You can get a lower interest rate. Yay! And this can be awesome at times of low interest rates, which we are not in right now. But let's say in a couple of years, we do go back to low interest rates. And now you can refinance your 7% loan for 4%, easily saving yourself thousands upon thousands of dollars and potentially getting rid of your student loans much faster. Again, getting a good interest rate will depend on your credit score and shopping around. And the second benefit, and this is going to be a weird one, it's really hard to include federal student loans in a bankruptcy procedure. But with private student loans, even in bankruptcy, it's not that it's easy to get rid of private student loans in bankruptcy, but it is much more possible to get rid of private student loans through bankruptcy. You still got to jump through a bunch of hoops. I'm not suggesting that this is a great idea for everyone. Editing Kate here to remind you that this is educational and informational only. You absolutely must speak with a bankruptcy lawyer to find out what's best for you. But it's kind of like if you were a caver, if you were spelunking and you got your arm stuck and you had to saw it off. That's an option because you're either going to die in the cave or you're going to have to saw off your arm, but you live, right? Bankruptcy is not a great option, but it's awesome for some people and it's what they should do. Anyways, not a bankruptcy lawyer. So not a bankruptcy lawyer. Talk to a bankruptcy lawyer. But I just wanted you to know that is a thing. Those are the two benefits. Let's talk about the drawbacks. And if you're thinking Kate, geez, you sound really down on refinancing student loans instead of just consolidating them, and some other YouTuber was all about refinancing. Yeah, are they getting paid by the refinancing companies? Because I'm not, because I wouldn't take their money. Yeah, there are two benefits. Here are the drawbacks. The giant drawback, as I mentioned, is that you lose out on all those federal student loan benefits like forgiveness, public service loan forgiveness, income-driven repayment forgiveness, all the other ones. You lose out on income-driven repayment plans. These base your loan on your income rather than the balance and interest rate, potentially bringing your monthly payment to $0. And then after anywhere from 10 to 25 years, you get the balance forgiven. You lose out on deferment and forbearance. Should you go back to school, if you're going through a hardship, private lenders don't care. You're going to still owe them that money every single month. Then there's also borrower defense to repayment, which pays off student loans if they find out you went to a predatory school or your school lied to you. But if you refinance, you lose out on that option. There are benefits that might not even exist yet, like the $20,000 forgiveness for interest. If the government hands out $20,000 to cover interest accrued on student loans, but you refinanced, you lose out on that. There are a lot of benefits to keeping your federal student loans federal with the government. Another drawback is even though you get a lower interest rate, they might extend the terms of the repayment period so much that you end up still paying more in interest. If you're an active duty service member, you lose that 6% interest rate cap benefit. If you refinance and include non-student loans, like you get a personal loan consolidation, so maybe there's a car loan or some credit card debt in there too, you lose out on the student loan interest tax deduction. This is only important if you regularly claim it. If you get a variable interest rate, it means that the great interest rate that lured you in, it changes, and now your bill changes, and now you may owe hundreds more per month and pay a lot more. And usually they're much faster about raising that interest rate than dropping it. Low interest rates are often accompanied by shorter repayment periods, so it may actually increase your monthly payment. It'll all just depend on your situation, who you sign with, the terms of that contract. I think it's pretty obvious I'm not the biggest fan of refinancing, but As I always say, personal finance is personal. You gotta do what's best for you. If you do need to lower your monthly payment, I would encourage you to look at the income-driven repayment plans before refinancing. So if you take nothing else from this video, remember this. Even though you might be able to save with a lower interest rate, you could be losing out in the long run. We just don't know what the future holds. I have a ton of great videos on all things personal finance and student loans. YouTube thinks that you would really benefit from watching this one right here in 4, 3, 2. Cheers. Yes, I'm missing one of my nails. Is unpainted. Don't look at it. Okay.